Hello viewers, welcome to my channel. I'm Hasham. So far 10 problems I have completed on computing the income from capital gain. In this video, two more problems, 10th and 11th I am going to explain. So after doing 10 problems, hope you already got some confidence on how to compute the income from capital gain. It's a simple, head of income. If you compare this income from capital gain with other heads like income from salary, income from house property, or profits and gains of business and profession, here we have only few provisions to remember. So before starting the 10th problem, 11th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Take the screenshot of the points written on the board, then I'll explain every point in detail. Now, see the problem number 11. 11th problem, you see carefully. Sri Kiran purchased a building for 3,15,000 in October 2001 and gifted his daughter Mrs. Jeevani in January 2023. So actually the old owner was Sri Kiran and the present owner is the daughter of Mr. Kiran, Mrs. Jeevani. So we have to compute the income from capital gain of Mrs. Jeevani. We are not concerned with Sri Kiran. Now, the other particulars are as under. Some additions were made in January 2003 for 2,10,000 and renovation of the house, capital expenditure, in August 2005 for 46,800. If the house is sold on 15th Jan 2022 for 22,10,300 and selling expenses 35,000. If cost inflation index for the year 2001-2002 is 100, 2002-2003 is 105 and 2005-2006 is 117. Calculate capital gain. The only new point in this problem is the assessee got the ownership by a special mode of transfer. Mrs. Jeevani has not purchased the house. She got the house in the form of a gift from her father. So the old owner was the father and the present owner is Mrs. Jeevani. She has not paid anything, but according to the provisions of Income Tax Act, the cost to the present owner will be the cost to the previous owner. So whatever cost of acquisition of Sri Kiran, the same cost of acquisition we apply to Mrs. Jeevani. That is the new point. Remaining all other points are same what we have done in the previous problems. Now, Mrs. Jeevani, computation of long-term capital gain for the assessment year 22-23. Consideration received. The selling price is given in the problem 22,10,300. From this we deduct the selling expenses. That is given in the problem 35,000. Deduct net consideration 21,75,300. From this we deduct the indexed cost of acquisition. Mrs. Jeevani has not acquired, has not purchased the house. She got the property in the form of a gift. But Income Tax Act says whatever is the cost to the previous owner is the cost to the present owner. So what was the cost of Sri Kiran? 3,15,000. 3,15,000 is the cost of Sri Kiran. The same cost we apply to Mrs. Jeevani. So 3,15,000 into current previous year index 317 divided by index number of the year in which the property was gifted. The property was gifted in January 2003. January 2003. So the previous year was 2002-2003. So 2002-2003, the index number is 105. So denominator will take 105. Right? So 3,15,000 into 317 by 105, 9,51,000 is the indexed cost of acquisition. This should be deducted from net consideration. That's why I'm putting in bracket. Bracket denotes subtraction, minus. Now, indexed cost of improvement. So after taking the property, some improvement were made. The other particulars are as follows. Some additions were made in January 2003. In the month of January 2003, some improvement additions were made for rupees 2,10,000. So 2,10,000 into 317 divided by 105. Because 105 is the index number for 2002, 2003, right? So it comes to 6,34,000, again in bracket denotes minus. Similarly, some more additions and renovation of the house, capital expenditure. Normally renovation of the house, we treat it as a revenue expenditure, but specifically given in the problem it is a capital expenditure, so we should take into account. So how much in August 2005 is 46,800. 46,800 is the expenditure, capital expenditure incurred. So indexed cost of improvement 46,800 into 317 divided by, what is the index number for 2005, 2006? 117. So divide by 117, we'll get 1,26,800. So we have indexed cost of acquisition, indexed cost of improvement, again indexed cost of improvement. So all the three should be deducted, minus. So 21,75,300 minus these three amount, you will get 4,63,500. So 4,63,500 is a long-term capital gain to Mrs. Jeevani. So here in working note you should write down, the SSC got the ownership of the property by special mode of transfer, that is gift. So the cost to the previous owner will be the cost to the SSC. The SSC and the previous owner acquired the asset after 1/4/2001. That means we are not concerned with FMV. If the property was purchased before 1/4/2001, then FMV will apply. Here no FMV. That's all. This is the end of problem number 11. Now problem number 12. See carefully, problem 12. Sri Ramakant, a non-resident Indian, is leaving to America to settle there permanently. First of all, the SSC is a non-resident. He sold the following assets in India during the previous year relevant to the current assessment year. Calculate the capital gain and income tax liability if income under other heads is nil. So the SSC is having only capital gain. He does not have any other income. He is a non-resident. Now serial number 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 assets are there. Article motor car. Purchase price, year of purchase is 2011-12. Cost price 5 lakh, CII, cost inflation index. Then sale price, use of the article. Actually, Income Tax Act is not concerned about the use of the article, right? Now, motor car. Actually, motor car is not an asset. When it is not a capital asset, there is no question of capital gain. So motor car, simply we give a note, working note will give that motor car is not a capital asset, so gain arising is not taxable. Secondly, house number 1, house number 2. Yes, both house number 1 and house number 2 are capital assets and the gain arising is a capital gain. TV set. TV set is a personal effect. That means an article which is used personally by the SSC. So TV set is not a capital asset. Gain arising is not taxable. So far 2 items we have seen, motor car and TV set. Painting work is a capital asset. Gold ornament is a capital asset. Silver chair is not a capital asset. Silver ornaments are there, it is a capital asset. But silver chair is a usable item, so not a capital asset. Urban land is a capital asset. Agricultural land, we assume agricultural land is located in rural area. In rural area, so it is not a capital asset. Precious stone is capital asset. So out of the 10 items, 4 items are not capital asset, so it is not taxable. Which are the 4? Motor car, TV set, silver chair and agricultural land. So out of 10, 4 are not taxable, 6 are taxable. So we make 6 columns. Sri Ramakant, house number 1, house number 2, painting work, gold ornaments, urban land and precious stones. These are the assets on which capital gain is taxable. Now first of all, consideration received. Consideration received means sale price. Sale price is given. Motor car, we are not concerned. House number 1, 6 lakh. So I have taken 6 lakh. House number 2, 20 lakh 25,000. It is there. Then we have painting work 2 lakh. Then we have gold ornaments 9 lakh 30,000. And urban land 5 lakh 10,000. Lastly, precious stones 10 lakh. So consideration received, sale price we have taken. There is no selling expenses. No transfer expenses, put a dash. The net consideration. Now, indexed cost of acquisition. We know how to calculate indexed cost of acquisition. In working note, I have calculated. The house number 1, the actual cost is 2,96,000. So 2,96,000 into current year index 317 divided by index of the purchase year is given in the problem. CII. Index number of the purchase year 184. So divided, sorry, not 184, 148. 148 is for house number 1. For 148, we get 6,34,000. House number 2, purchase price 4,40,000 into 317 divided by 220. We'll get this amount. Painting work is 36,800 is the purchase price. Index 317 by 184. 317 by 184. Gold ornaments, the purchase price 1,84,000 into 317 by 184. 317 by 184. Urban land, the purchase price 1 lakh into 317 by 100. 317 by 100. Lastly, precious stones, the purchase price 2,74,000 into 317 divided by 137. We'll get. So all the indexed cost of acquisition we have calculated. Write the indexed cost of acquisition. Now ultimately we get long-term capital gain or loss. If you are getting negative, it is a loss. If it is getting positive, gain. So 6 lakh minus 6,34,000. You are getting minus 34,000. So it's a capital loss. So there is a capital loss on house number 1. Whereas 20,25,000 minus 6,34,000. 13,91,000 long-term capital gain. 2 lakh minus 63,400. 136,600. Long-term capital gain. 9,30,000 minus 317,000. 6,13,000. That is also gain. 5,10,000 minus 3,17,000. 193,000. That is gain. 10 lakh minus 6,34,000. 3,66,000. Long-term capital gain. So out of the 6 assets, first asset we are having loss. Remaining all 5 assets we are having the gain. And according to the provisions of Income Tax Act, the capital loss can be set off from capital gain. So long-term capital loss can be set off from long-term capital gain. So here in note, motor car, TV set, silver chair and agricultural land are not capital assets, hence gain arising is not a capital gain. Right? Now we want to find out ultimately what is the total capital gain. So LTCG on house number 2, 13,91,000. LTCG on painting work 136,600, 613,000, 1,93,000, 3,66,000. If you add up the 5 amounts, you are getting 26,99,600. From this we deduct the long-term capital loss on the sale of first house, 34,000. Subtract, we'll get 26,65,600. This is the taxable LTCG. Now, for basic exemption, if the SSC is a non-resident, then basic exemption of 2,50,000 will not be given if the SSC is having only LTCG. In our problem, it is given that the SSC does not have any other income. He is having only income from capital gain. So basic exemption of 2,50,000 is not allowed for non-resident SSCs if they are not having any other gain, any other income. So 2,50,000 will not be allowed. So directly we have to calculate the tax, LTCG tax at 20% on 26,65,600. So here tax on LTCG 20% of 26,65,600, 5,33,120. To that 4% health and education cess 21,325. So tax liability is 5,54,445. So if you make a round off, so instead of 45, we make it as 50. According to the provisions of Income Tax Act, the income tax should be rounded off to the nearest 10. We take 40 or 50. So 50 is near to 45. So we'll take 50. That's all. So in this video, 2 problems I've explained, that is 10th and 11th. So inshallah we'll continue the next problem in the next video.